and then you could see it spread around the world, and that's what nobody wants to see. And I think that's what people were worried about the Lehman event in 2008, and the Fed stepped in and handled it. The problem is the problems are much bigger now across the world, and each of the countries is having sort of their own potential Lehman-type issues. And so it'd be interesting to see if we can kind of stem the tide of all this contagion and keep it from lighting a wildfire and spreading around.
This week's specials with Miles Franklin Precious Metal Investments. Type 2 Silver American Eagles for only $7.25 over spot. Call us at 1-888-81-LIBERTY. That's 1-888-815-4237.
Hey everyone, this is Elijah K. Johnson with Liberty and Finance. And back with us today is our good friend Robert Kientz from Gold Silver Pros. Robert, thank you so much for joining us today.
Thanks for having me on, Elijah. A pleasure.
Yeah, it's great to have you. And I'd like to have you kind of talk about what we've seen in the last week with the volatile market. We saw gold and silver crash, but now they've pretty much made back up their gains. It seems like the general trend this quarter, though, we've just been seeing smash downs in the price for both gold and silver. And, you know, we've had you on every time, right? So your perspective on kind of what we've seen this week, and then kind of more broadly as we've ended the third quarter of 2021.
So it looks like from a gold perspective, we've recovered back to early August, when we had basically a big smash down in price at the very beginning of August, from a little over 1,800 down to about 1,720, and we've recovered to about 1,750. So we're almost where we were when the month of August started in gold. And silver is a little bit different story. We're sitting at that key $22 support line. I know last time we were also on with Steve Penny, the silver chartist, and he was talking about how 22 needs to hold in silver. And if it does hold, that's good news, because it's a support line dating back all the way to the 2010, 2011 markets. It's fairly important. He thought that if we had breached the 22 line and stayed down, we could go all the way down to $19 in silver. It looks like as of right now, that's not going to happen, at least ending up September, beginning October. You know, that critical support has held. During the summer months, there tends to be somewhat of a, sell the market and go away in the precious metals. Sometimes this happens in stocks too, although not as much this year. The stock markets have been doing fairly well. I say fairly well. September, they've actually been down. But over the months, the stock markets did better than gold and silver. I look for gold and silver to rebound because we're getting into fall. Historically, that is the love trade in gold, which is the ceremonial demand and investment demand in India and China and some other Asian nations. And then silver tends to do better as well from industrial demand, because leading up to the Christmas season, all the demand for silver. So the precious metals, haven't had their best month, but we see a little bit of recovery here today. I think silver's up 2% today and gold's up about 0.5%, so not bad for the day.
Definitely, and you're expecting kind of coming into the end of the year, because of the love trade, both gold and silver to rally. Do you have any price targets you're looking for really to the end of the year?
Well, it always gets tricky to make predictions. I will say this: the gold is on long-term cup and handle for about 10 years. And it looks like it may be exiting that handle because you've got a bullish flag pattern on the chart dating back to April, meaning instead of gold going down, it's really kind of trading sideways like this within a range. Silver is also trading within a range. Silver has been in the same range between 22 and I would say $30 since August of last year, and between 22 and 28 since about June of this year. Now, silver is in a downward trend, but the key $22 support line has held. And that's the key thing. So I do expect gold and silver to go up. From a macroeconomic perspective, gold typically leads silver on big rallies, and gold has a much more bullish long-term chart than silver does. So I would expect gold to go up to the love trade, and that silver would follow it a little bit. I don't know, without an economic crisis, if either one is going to challenge, previous highs that we saw. Last year, I think gold hit 2060 and silver hit right at that $30 mark. I'm not necessarily expecting to breach that unless some of the contagion we see in the market, especially in China, comes to fruition. Then you could see gold and then silver trade sharply higher. And when I'm talking about contagion in China is you've had the Evergrande debt situation in China. It's the largest high yield or junk debt issuer in China and the second largest financial institution in the second largest economy in the world. And that situation's not quite resolved. There have been a few things around maybe securing the onshore assets and doing some other things, but there's not a full bailout. It doesn't look like the Chinese government's going to do a full bailout, at least at this point. They're going to kind of see where it goes. And what they've been doing instead is issuing currency and debt into the market to keep liquidity up, to keep it from becoming a systemic contagion. We've also seen some energy issues in China. There's an article here at Zero Hedge that says China panics, Beijing orders energy firms to secure supplies at all costs. And just looking at some of the recent news, Goldman cuts China's Q3 GDP growth to 0% as a result of the energy crisis. Millions of Chinese residents lose power. Chinese coal prices soar to record highs as China restarts coal. They were wanting to get away from coal and do nuclear and other sources because of pollution, but they've restarted a lot of their coal plants to deal with the energy crisis. There's also an energy crisis going on in Europe. And when you have simultaneous energy crisis in two different continents and two different major world economies, that can affect output, that can affect GDP, and eventually it could affect the debt of those countries. So we'll have to see if that electricity and energy crisis morphs into some sort of financial crisis. It's too early right now, however, to tell.
What would be some of the catalysts for that, for really the crisis in China, the crises in China, and also the crisis in Europe to spill over to the U.S.?
Well, in either case, because all the global banks are connected, if you look at foreign direct investment, from a commercial perspective where banks are investing in other countries, and you look at from a trade perspective where you have current account flows across different countries, and you look at from a sovereign perspective where countries will issue debt and issue currency and it gets stored and traded by other nations as a result of that current trade account, the actual physical product trade. You look at all those things, and if any of those gets turned over or gets upset, any of those flows gets upset, it can start a contagion. And each country tries to manage their debt and currency separately, but really it's an interrelated game. And so what may have to happen if, for example, Evergrande blows up or something happens in Europe due to their energy crisis and it lowers GDP, somebody has a debt default, something like that. I don't think you'll just see those nation states try to address the issue by printing money or introducing new liquidity, say, into the repo market, the short-term markets. I think also what you may see happen is the IMF get involved, perhaps, because they don't want it to turn into a global contagion. So I have said for the last few years, I do think that the next financial crisis is going to occur because of a debt default in the commercial banking sector. I said about 10 years ago it could be Europe. Now we're looking at China. And of course, the United States as well has a lot of debt, although we seem to be, for the short term, a tad healthier in terms of not having an immediate debt crisis. But yeah, they're all interconnected, Elijah. And if it starts one place, if the policies of the debt systems and the currencies are not coordinated amongst countries in which that would affect and propagate through trade and currency trade, then you could see it spread around the world. And that's what nobody wants to see. And I think that's what people were worried about the Lehman event in 2008. And the Fed stepped in and handled it. The problem is the problems are much bigger now across the world, and each of the countries is having sort of their own potential Lehman-type issues. And so it'd be interesting to see if we can kind of stem the tide of all this contagion and keep it from lighting wildfire and spreading around.
I think that's very key. And I mean, this is all happening as we see the Fed possibly tapering in November. So how do you see that all playing out then?
Well, I think from a policy perspective or a philosophical perspective, the Powell-led Fed wants to tighten. I think they wanted to tighten. Earlier we had a correction fourth quarter 2018. The Fed did, and I think philosophically they don't want to continue to issue currency and debt forever. If you look back at M1 statistics from 2020, due to the pandemic, we created 40% of all money created in the history of the U.S. dollar dating back to 1913. And if you look at the chart of M1 and M0, they both went vertical, literally vertical in 2020. So we've got the currency out there. We've also issued a lot of debt. There's a lot of debt. We had that big debt. We had the big debt ceiling debate going on right now in Congress. And it just seems as though they want to curtail because they know what happens at the end of it. If you look at history, when you issue too much currency and you have too much debt, there's usually a debt default and or a hyperinflation. Most countries will go to hyperinflation to avoid the debt default, to avoid that deflationary collapse of the debt system. The Fed knows this. Now, they're jawboning and what they're trying to do right now is say, well, we want to taper. And in the most recent Fed meeting minutes, a lot of the board of the governor said, we're going to push back potentially tapering a little bit, but we're going to pull forward interest rates hikes from 2023 to 2022. So now you're seeing this sort of shifting of policy, or moving a goalpost, if you will, between the two main policy actions that the Fed could take. I don't think there's clear guidance. I think the market is somewhat confused, but the Fed is going to continue to talk about this in jawbone, to not to actually do anything, but to say that they may do something to calm the markets down. Whether or not they're actually able to do it in this environment where you see fires starting to brew in Europe and China, again, the world's connected, Elijah. The U.S. can't just look at its own economy and issue policy. It's got to look at what's going on everywhere else. So ultimately, if they try to taper, I think it could cause some contraction in the economy here, because we're so addicted to the money and the debt, the cheap interest rates. But they want to do it. Philosophically, that's what they want to do. They want to try to rein in. They think they can still control it by expanding, contracting at will. Whether they can, I guess we'll see.
How do you think that'll impact gold and silver? Because you are expecting gold and silver to rise as we go to the end of the year. But if we see this taper, then that seems like it would be bearish for metals.
It could be. I think you have to see the results of the taper. If it's a light taper, I do think the market will take that as a sign of confidence, and I don't think it's going to help the metals. I don't know if it'll reverse the overall typical fall increase in the metals prices. It could stunt them or thwart them just a little bit. But if they do a fairly substantial taper, and the U.S. corporates, for example, react to it, or the debt markets react to it because there's less liquidity, or there's the Fed's buying less of the debt, therefore, and we know the overseas buyers don't want to buy as much, therefore some of the debt, when they auction it, may be higher prices, right? So it may cost more, so the Treasury may pull some of that back. So you got to look at all the dynamics. It depends on how much they do. I think they're going to throw a trial balloon. I think they're going to throw a trial balloon out there, something light and easy, see what happens, measure that, and then come back with something else, maybe a little bit bigger, based upon the data they get. But remember, this is a very dynamic environment. So I do not think the Fed's going to strictly taper. I don't think they're going to cut all of their asset purchases out. I think they'd be absolutely insane to try to raise interest rates right now with the potential contagion you see going on overseas. But we'll have to see what happens. If they do a hard taper, that's going to negatively affect the economy. You'll see precious metals prices rise. Now, there will be a little bit of a delay. You'll have to see the negative news come out. So there may be 30, 60 days before you see that happen. But a hard taper would push metals to the upside.
And kind of looking at the long-term view, then, you've recently stated on your YouTube channel and gone through the data of where all the wealth is going right now, where the wealth is being transferred. And over the last few years, I mean, we've seen quite a rise in both real estate and the stock market. And that's where the wealth transfer is happening. But you've also said that you believe in the future that is going to be reversed, and now people who are holding hard assets like gold and silver are going to have the wealth transferred to them from the stocks and real estate. So your perspective on that?
Yeah, so my view on that is I did a presentation that showed over the years the wealth transfer into assets in which most people don't own. Most people, you get the impression by listening to the financial media that almost everybody in the United States has a 401k, a pension plan, lots of stocks, and very expensive real estate. If you actually break those markets down, the average middle class person does not have a robust 401k. They do not have enough money to retire on. The average person in the United States, this came out last year, there's this economic study done, doesn't have an extra $400 sitting in their bank account in case they have an auto bill or a plumbing issue, or something breaks. But the people that own the stocks tend to be the top 1%. So the 1%, the wealth transfer, dating back to about 2005, 2006, when I started, looking at that time frame, has gone to the upper 1%. A little bit of it's gone to the upper 10%, the 90 to 100%, what we typically would consider the upper class. But it's the upper of the upper that's got the vast majority of that. And also in real estate, because even though real estate prices have risen, people have continued to take on more debt. And the real estate rises. If you break down the real estate market, it's the upper end of the real estate market that's done the best. And it tends to benefit those people that have wealthier incomes, investors who invest in residential and commercial real estate. So it's people at the top end where that wealth has been transferred. The bottom 90% of the population has seen a net reduction in the overall share of wealth in the United States dating back to 2005, 2006. And I think, Elijah, this is a reflection of the policy of the Fed, because when you push so much money out, it first goes through these large commercial entities and filters down into the system that people have existing assets. It doesn't trickle down to the people that don't have it. What it does is cause inflation and erodes their purchasing power over time. That's why we advocate gold and silver. And one of the things I said in that video was, even if you don't have a lot of money and you can't even afford an ounce of gold, buy some silver, because over time, or buy 1/10 of an ounce of gold if you can, or even a gram. Some people sell the gram golds that you can order. Do that, because what that will do is it will offset that price inflation over time that's eating out your budget and give you some savings over time. And since 2000, Elijah, gold and silver have beaten the tar out of the major stock market indices. So even though the stock market has transferred a lot of wealth to the super elite, the precious metals, which is a much smaller market, has actually done better. So people that have held precious metals would have done better than if they held, say, the S&P, the Dow Jones, the Wilshire, the Russell, or any of those indexes. And in most places, real estate as well. Although in some places, real estate is in a huge bubble, and that might have been your best asset. The problem is, if you're in a huge bubble, you're now at risk, because real estate prices in the last month have started to pull back. That's been in the news. So prices for the first time in the last month in September began to pull back for the first time, I think, all year.
In your view, with respect to real estate, because it does seem like prices just continue to rise, you're saying it's in a bubble. Besides just the prices rising, what other indication do you have that real estate is in a bubble?
So if you're looking at an aggregate statistic, and this is something given to me by the economic ninja at the Silver Symposium in Idaho we just got back from, and I went and looked it up and agreed with him on this. He said we're at a point right now in which only 1/3 of the population can afford the average house, only 1/3. Typically, real estate is about evenly priced in a healthy market when about 2/3 of people can afford the average house. Now, I'm not saying can afford the most expensive house. I'm saying the average house, the average 3-bedroom, two-bath house, which in Texas is probably about $140,000. California might be looking at, $400,000 or $500,000. Florida, everybody has different rates. But when only 1/3 of the population can afford the average house, the prices have to come down, because what happens is, if let's say you spend 2/3 of your budget on getting a house, and you shouldn't. Most lenders won't give you 2/3. The limit is usually 1/3. But in this easy credit time, a lot of times you can get these ninja loans or these either undocumented loans, or they'll allow you to spend more than what you can afford. So let's say you spend 2/3 of your income on your house. How do you afford to pay for your car, for gas, for clothing, for electricity, for all those other things that you need? Has this been a recipe for a disaster over time? So that real estate market is going to have to correct, and historically it has. It will come back down to where the average person, or 2/3 of people can afford the average house.
So right now it seems like maybe hold off on the real estate play and move more into precious metals.
Yeah, real estate is very local, so you can find some deals. I would also say, depending on where you are, if you can find productive farmland, that tends to bubble less, and it tends to almost never crash, and it actually holds up very well against the precious metals over super long periods of time. So if you're generational wealth building, a lot of times you can go get good farm or ranch land. The key is to get it in a low tax jurisdiction and get it far enough out from the cities that it's not overpriced. Anything near the cities now is being overpriced, especially in areas, especially in Texas, where people are moving right and left, and real estate prices have been bid up. If you don't want to hold real estate, you don't want to worry about that. It's a bit of an active investment. I would say precious metals would be your number one bet. Gold specifically, if you're long-term, because gold tends to be less volatile than silver, and long-term builds or saves the most wealth. If you want to speculate a little bit, go into silver, because I think the upside to silver, due to both industrial and what I think is going to be an onslaught of coming financial or monetary demand, is going to cause silver to rise even more sharply.
One of the arguments that people make against precious metals is that it doesn't produce anything. Your perspective on that? I mean, we can see precious metals increase in value over time compared to other assets, but at the end of the day, if you hold gold, it's not like it produces more gold, right? So your perspective on that argument against holding precious metals?
Well, James Turk of Gold Money had an excellent article on this on Seeking Alpha, I want to say about a year ago. And he dispelled a lot of the myths about precious metals, Elijah. And one thing that he dispelled was you can lease gold and make money off of it. So you can financialize gold if you want. It is possible to make money on it. You can lend it out. Now, whether you want to lend it out in this environment and give it to somebody else and expect that they'll give it back to you, I don't know. I mean, you have to trust that other person. But it is possible to lend out any asset of value that holds its value over time and get a return on it, and that includes the precious metals. Typically, it's not done, though. Typically, you don't earn an interest rate. Most of the time, people just store it and pay for it, and there is some storage cost depending on where you put it. But that is a fraction of the amount of value that they capture over longer periods of time. So to put your metals to work for you, it's not like a stock where you're day trading that stock over a day, a week, a month, or 2 months, and you're expecting an immediate speculative return, assuming all the other greater fools in the market want to buy that stock more than you want to sell it. And that's a big assumption. When the Fed's printing money, that's a lot easier because there's more money to go around. When there's a crash, everybody wants to get out of the stock market. And that's when people will flock into gold. So if you're looking long term, that gold and silver is going to suck up all that wealth that's going to come out of that real estate market, that stock market, some of those overinflated markets as well. And that's one of the other things I talked about in the video that you referenced, Elijah, in terms of the wealth transfer from 2005 to 2020. If you were in gold, you received a higher proportion of that wealth transfer than you would have in the stock market. But wait until that stock market breaks, because when the stock market breaks, and it does every 4 to 10 years, it will revert to the mean. The P&E's price to earnings ratios on the stock market are like at all-time highs. Okay, it will revert back. When it does, where's that money going to go? It's going to go to real tangible assets. It's going to go to your gold and silvers. It's probably also going to bid up some land. Personally, I would rather be in productive farmland than be in an apartment rental, but there are certain types of real estate that may do well. I think the residential market's going to come under severe pressure. And we've seen the last couple of years since COVID, we've seen the commercial real estate already come under tremendous pressure. So at the end of the day, when those bubbles pop, it's going to flow into gold and silver. And that's where you're going to get your returns because you're buying low now. You're buying, relatively speaking, at a low point in the cycle in the precious metals.
All right. Well, Robert Kientz, we really appreciate your time today. Before we let you go, did you want to share with the viewers where people can find you online and any last thoughts you had?
The easiest place is just simply hit us up on YouTube under Gold Silver Pros or on Twitter under Gold Silver Pros. You can email me at robert@goldsilverpros or go to our website, goldsilverpros.com.
Robert, thank you so much for your time.
Thank you, Elijah.
This week's specials with Miles Franklin Precious Metal Investments. Type 2 Silver American Eagles for only $7.25 over spot. Call us at 1-888-81-LIBERTY. That's 1-888-815-4237.